Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In this chapter, Equity Markets and Stock Valuation, we will introduce several techniques that investors are using to evaluate both common stocks and preferred stocks. In addition, we will examine some important features of common and preferred stocks, focusing on shareholders' rights. And we will close out our chapter with a discussion of how share stocks are traded on the financial markets and how stock prices are reported on the financial markets. And here are key concepts and skills you're supposed to possess at the conclusion of this chapter. First of all, you need to understand how stock prices are calculated based on future dividends and dividend growth. Of course, you should be able to compute stock prices using the most important formula they are going to use in equity valuation, which is a dividend growth model. In addition, you are supposed to understand how corporate directors are elected and the various shareholders' rights associated with the common shareholders and the preferred shareholders. And finally, you need to understand how stock markets work and how stock prices are quoted. All right, let's look at the outline of the chapter. And essentially, we need to fix three important issues. The first one is common stock valuation, and the second one is some very basic features of common and preferred stocks. And the last one is learn some mechanism on how stock markets work. Now, let's take a look at a stock. Let's say you own a stock. Well, if you are owner of stock, you are the boss of the stock. And the value of the stock can be derived from the future benefits that you can get from holding this stock. And essentially speaking, you have two ways to get future cash flows from your stock holding. The first one is to receive future dividends that the company will pay for the stock. And the second way is to sell your shares in the future to receive the price of the stock. And here you see there's some similarity between bonds and stocks in terms of cash flow. And if you hold a bond, you will receive both coupons and principals. But if you hold a stock, then you're gonna receive dividends and the stock price that you will receive in the future. And typically investors buy low, sell high to get so-called capital gains. Now let's start with a very simple example to see how we can price a stock. Suppose that you are thinking of purchasing the stock of More Oil Inc. and you expect this company to pay $2 dividend in 1 year. You also believe that you can sell the stock for $14 at that time. So you're going to hold the stock for 1 year, and you know that during the future year you will receive $2 dividend and $14 of stock price at the end. And the required rate of return for investment is 20%. So based on information here, let's take a look at how you can calculate a fair stock price. And here we use cash dividend discounting method to get stock price estimation. First of all, we look at cash flows that we can receive in the future year. And here there are two shots of cash flow. The first one is $2 dividend. The other one is future stock price, which is the $14. In total, the cash flow that you are going to receive is $16. And that $16 is cash flow that will happen in 1 year. Therefore, in consideration of time value money, we need to discount that cash flow by using the required rate of return as discount rate. So P0, which is the stock price right now, 0 means times 0 equals discounted future cash flow, which is $16. Right? And that will give you $13.33 of stock price estimation. The reason why I say estimation is because the amount of cash flows and discount rate are all estimated by individual investors. And at any given point, you don't know exactly how high the stock price can go and what dividends the company will pay. So $2 dividend, $14 stock price that you will see in 1 year are all based on estimations. And also discount rate 20% is another estimation. So here stock valuation is not about 100% scientific calculation. It's about art of estimation. Now let's extend our example a little bit, and let's assume that investor will hold the stock for 2 years. Right. During the first year, the investor will receive $2 dividends. During the second year, investor will receive $2.10 of dividend. And also the stock price at the end of second year would be $14.70. So here you have total cash flow around $18.80, but the timing of cash flows are different. And then you have 2 time periods. For the first cash flow, which occurs in the first year, is $2. And during the second year, you will receive 2 cash flows. One is dividend, the other one is future stock price. All right, which is $2.10 and $14.70. That will give you $16.80 cash flow during the second year. So the stock price would be based on those cash flows for the next 2 years. And based on the equation that you see here, we are essentially doing discounting. We discount the first cash flow, $2 of dividend, at a rate of 20%, and we discount that cash flow for once. And for the cash flow that you are going to receive during the second year, we discount it for twice. When you add up those numbers, you will get $13.33. Now we can expand this analysis a little bit further to consider 3-period example where investor hold this stock for 3 years, and the dividend would be $2 for the first year, $2.10 for the second year, and $2.20 for the third year. And at the end of third year, stock price would be $15.43. And here you have cash flow from 3 different time periods, and we will discount those cash flows accordingly, as you see based on the equation on the slides. And the stock price is also equal to $13.33. And actually, we can expand this infinitely to do 4-year period model, 5-year period model, all the way to M period model, and we will discuss that case a little bit later. But now let's take a look at how we can use calculator to help you to do the calculation. Based on the 3-period model, you need to discount 3 cash flow. 3 cash flows based on the stock. And sometimes you do not like the calculation here because it involves 3 items calculation. And if you hate manual calculation, no problem. You can let your calculator to help you to solve the problem. And here we can initiate cash flow function and let your calculator know those cash flows. And once you enter the discount rate, which is 20% in this case, the calculator will automatically give you the answer of the stock price, which is MPV on your calculator. So MPV on your calculator is equivalent to stock price estimation. And I suggest you to utilize your calculator to do several practice to see if you if you could be comfortable with this this process. It can help you a lot. But if not, it's okay because you can still do manual calculation in this fashion. Okay, let's say we can continue. This process to include n time period model. Let's say you're gonna hold a stock infinitely. Then what will be the stop price based on that? Well, in theory, stop price P0 hat. P hat means estimated stop price. 0 means at time 0. So estimated stop price at time 0 should equal to discounted dividends that investors are supposed to receive in the future, right? And here you see D1, D2, D3 all the way to Dn. And here we discount those dividends accordingly based on the discount rate. And essentially, the estimated stop price at 0 equal to the sum of present values of all future dividends that the investor will receive in the future. So this formula is the fundamental equation for stock valuation, right? And it showed you very clear mechanism that a stock price is equivalent to the present value of all future dividends. However, in practice, it is basically impossible for anyone to utilize this equation to come up with stock price estimation. Why? First of all, there are infinite number of items in this equation. I mean, you can add up 100 items, 1,000 items, or even 1 million items, but here it's infinity, right? And the second problem is, how do you be so sure about those future dividends? D1, D2, D3 all the way to Dn. I mean, you can have some reasonable estimation on D1, D2, D3, but how can you so be sure about dividend that the company will pay 10 years from now, 20 years from now, or 100 years from now? So there are great uncertainty on dividend payments because corporations do not have any liabilities, do not have any legal liabilities to pay fixed amount of dividends to shareholders. I mean, dividend payment depends on corporations' operating results. If company makes more money, they may pay more dividends. If they don't make money, they don't have to pay. So dividend and the amount of dividends has great uncertainty in this case, and investors need to estimate those dividends. So after all, this equation makes sense in terms of valuation mechanism. However, it is basically useless, right? So how can we evaluate a typical stock that pays dividends? Well, we have 3 different scenarios to consider depending on the growth of the dividends. I mean, what we know about a stock is it's past the dividend. Let's say the dividend that the company paid during the last year. But what we need for stock evaluation is future dividends. So what we know is D0, the dividend during the current time period. But we need D1, D2 all the way to Dn. Those are future dividends. And there's a certain way that investor can utilize to estimate those D1, D2, D3 all the way to Dn if we know the growth of the dividend. So what we know here is D0. If we know the growth of dividend, then it gives us a reasonable base to estimate future dividends. So here we focus on the growth rate of dividend, and let's assume that dividend will follow a reasonable number, let's say 5% each every year, 3% each every year. If that is the case, then we can reasonably estimate future dividends, right? And here we have 3 different scenarios. I mean, some companies do not have any growth in dividend. In that case, is constant dividend or zero growth, and this is a typical case for preferred stocks. And for most of preferred stocks, the dividend payment is fixed, so there's no growth. So if that is the case, how can we calculate a preferred stock prices? And the second case is that, okay, let's say company is pretty good company. It follows very stable growth, 5%, 3% each every year, and the dividends will grow in that fashion. If that is the case, then what we can do to estimate stock price. And the last case is that, okay, company may have uneven growth rates. Company may grow very aggressively for the next 5 or 7 years, but eventually the growth rate will decline to a constant and more stable but pretty low level. So that is a super normal growth scenario. And we need to consider all three scenarios for stock valuation. Okay, now let's take a look at the first scenario where there's no growth for dividends for a company. And we know that this is the very typical case for preferred stock. Right? And the dividends are expected at a regular interval forever. And if you draw a timeline, you see that the future cash flows are pretty much like annuity, right? That will last forever, and we know that this is a perpetuity. And the present value of perpetuity equals that annual cash flow divided by the discount rate. And here, the annual cash flow is the dividend, and the discount rate here is required rate of return for the preferred stock. So for preferred stock, P0, preferred stock price at time 0 equals that fixed amount of dividend divided by the discount rate. Right, now let's use an example to demonstrate how we can calculate a typical preferred stock price. Let's say stock is expected to pay 50 cents dividend every quarter, and the required return is 10% with quarterly compounding. Then what would be the stock price? And here, the quarterly dividend is 50 cents. And the required return is, you say 10%, wait a second, 10% is annual rate, and the 50 cents is on a quarterly basis. Therefore, we need to use quarterly discount rate, which is 10% divided by 4, or 2.5%. When you complete your calculation, you will see $20 of preferred stock price. So for preferred stock, it's pretty easy to calculate its price. It equals fixed amount of dividend divided by the discount rate. Now let's take a look at another scenario where a company will experience a pretty stable or constant growth in the future. Right? And in reality, you would say, hey, this is not very realistic assumption, but this assumption allows us to simplify the calculation to get an approximate estimation of a stock price. Right? And here, let's say the company follows a constant growth for its dividend in the future, all the way from 1 year to 2 years, all the way down to N years or T years. And if we know D0 and this constant growth rate, then we will be able to estimate dividends in the future, D1, D2, all the way to D2. Right? And once we get all those numbers, for example, D1 equals D0 times 1 plus G, and the D0 is $2, and the G is 6%. Therefore, the D1 would be $2.12. And the D2 equals D1 times 1 plus G. And that is $2.24, 72. And we can do this similar thing for D3, D4, D5, all the way to DN. Right? All the way to DN. So you would say, hey, this calculation doesn't help us because we needed to add up infinite number of items in our calculation to get a stock price estimation, even when the growth rate is a constant number. Just like what you see in the first equation, right? Stock price estimation at time 0 equals d0 times sigma means the sum of many items, and actually if t is from 1 to infinity, then there will be infinite number of items. Right? And the first equation cannot be solved easily because it's infinite number of items. And many years ago, 100 years ago, Professor Gordon at MIT actually thinking about this stock valuation problem, and he came up with this first equation. And he know that, okay, stock price equals present value of all dividends, and if we assume the constant growth rate, then we will come up with this pretty complicated equation. And he just cannot get a further solution to this equation, so he seek help from a mathematical professor, and his friend, who is a mathematical professor, look at this equation and he smiled because he know that, okay, this equation is essentially equivalent to the second one that you see on this slide. It's equivalent. Stock price at the time 0 equals d0 times 1 plus g divided by the difference between required rate of return and the growth rate. Or it equals d1 divided by r minus g. And we call this the golden growth model because it was discovered by Professor Gordon many years ago. Right? Now, this golden growth model gives us a very powerful tool to estimate the stock price. It also reveals very basic mechanism in stock valuation. Now look at this P0 hat. P0 hat equals D1 divided by the difference between R and G. So essentially there are three factors in this formula determine stock price. The first one is dividend, and the second one is required rate of return, and the last one is G. Only three factors. Right? And notice that the dividend here is not D0 but D1 because only future dividends matters for stock valuation. And the second factor is required rate of return, and the third one is G, the growth rate. Right? So this equation has great deal, has something to do with the growth rate and was discovered by Professor Gordon. That's why we call it as a golden growth model. And this is the most fundamental equation that investors use for stock valuation. And you would say, hey, let's try out this equation to see if we can fix some typical stock valuation problem. Well, let's suppose Big D Inc. Just paid a dividend of 50 cents, and this company is expected to increase its dividend by 2% every year. And this 2% growth will continue, and this is the constant growth rate. If the market requires return of 15%, okay, this 15% is discount rate. How much should the stock be selling for at this moment? And in this case, since dividend will grow at a constant rate every year, therefore we can apply this golden growth model. Right. And what we have in this question are essentially three numbers. The first one, 50 cents dividend, and the second one is 2% the growth rate, and the last one is required rate of return. And here you need to be very careful distinguishing the difference between D0 and D1, because in the equation we essentially need a D1, and this D1 can be estimated based on D0, and D1 equals D0 times 1 plus G. Right. So in this case, D1 equals 50 cents times 1 plus 2%, and R here is 15%, and the 2% is the growth rate. So when we plug number into the golden growth model, we'll get $3.92 of stock price. Right. And in this case, you needed to do a little algebra on your calculator to solve the problem. And what I suggest is first of all, you need to avoid putting percentages into your equation. Right? For example, you shouldn't put 2%, 15% into the equation. It's better to use a real number. 2% equals 0.02, 15% equals 0.15, so on and so forth. Right? So in that fashion, you can avoid some future mistakes in your calculation. The mechanism is pretty straightforward, and you know the equation, you know how to apply the equation, and you need to go through calculation very carefully, make sure you can get 100% accurate answer. Now let's take a look at another example. Let's say TB Pirate Inc. is expected to pay $2 dividend in 1 year if dividend is expected to grow at 5% each every year and require rate of return 20%. Then what is the difference? Well, and here you see D $2, R 20%, G 5%. And here you can apply those three numbers directly into golden quote model to get an answer. And notice the $2 dividend here is future dividend. Look, company is expected to pay $2 dividend in 1 year. That is D1. Now, let's go back to the first question. Big D Inc. just paid a dividend of 50 cents. In this case, that 50 cents is D0 because it's dividend that has been paid. But in this question, this $2 is the dividend that the company is going to pay. Therefore, this $2 is D1. So for your homework exercise and for your exam, I want you to be very careful about the difference between D0 and D1. Make sure you capture the right number. All right. So here's another trick that you need to pay attention to in terms of calculation. Let's say P0 equals $2 divided by 20% minus 0.2 minus 0.05. How do you operate this on your calculator? Many people start with 2 divided by 0.2, then minus 0.05. In that case, you will get the wrong answer because essentially what your calculator does here is 2 divided by 0.2, then minus 0.05. This is not what you need. What you need here is 2 divided by the difference between 20% and 5%, or 2 divided by 0.15. So you need to do the higher order calculation first, and in this case you need to do 0.2 minus 0.05 first. That is 0.15. Right? Then you take the reciprocal of that number and time it with $2 to get the answer. Okay, golden growth model is a very simple model that investor can utilize. It's easy to utilize and it makes sense. And more importantly, this equation shows the very basic mechanism of stock price, stock valuation. And essentially, we discovered there are 3 key factors determining stock price: dividend, required rate of return, and the growth rate. And I would say the most sensitive factor here is the growth rate. Now, let's take a look at this picture. This picture showed you the relationship between growth rate and the stock price. When growth rate is low, let's say 2%, 3%, stock price is low, $3, $4, $5. If that growth rate increase to, let's say, something around 18%, 19%, look, stock price will go all the way up to $200. So from this picture, you see there's exponential relation between the growth rate and the stock price. Higher growth rate, of course, will boost the stock price, not linearly, but exponentially. That explains why those high technology company has very high valuation or very high stock price relative to its dividends. right? And for the company that has low growth, you tend to have low stock price. And this picture showed you another relationship, the relationship between required rate of return and the stock price. And the relation here is negative. I mean, look at the first one. There is a positive relation. Higher growth means higher stock price. And also here you see a exponential growth function. But here you see a negative relation, which means higher discount rate, lower stock price. Does that make sense? Well, stock price is the present values of all future dividends. Well, if we use a higher discount rate, then we will have lower present values or lower stock price. So that makes sense. And also here you see exponential function in terms of the relation between required rate of return and stock price. When required rate of return was low, well, stock price would be high. And when that number increase gradually gradually and aggressively towards 25%, you see stock price decline dramatically. See, for the same dividend of $2, given 5% growth rate, stock price gonna be about $200. But when that discount rate go up to 20%, 25%, look, what is stock price? What is that? Less than $10. Right? So there's a significant relation between required rate of return and stock price, and that relation is negative. Higher required rate of return, lower stock price. So nowadays, people always have discussion on so-called interest rate, Federal Reserve. Will Federal Reserve increase interest rate or cut interest rate? Right? And what really matter here is the interest rate, because higher interest rate, higher discount rate, which will lead to lower stock price. So every time when you hear the Federal Reserve is going to cut interest rate, is that good news or bad news for stock holding? Well, that is good news, because when interest rates are declining, required rate of return is declining, which will boost your stock price. You see that? And higher interest rate means higher discount rate, higher required rate of return, which will depress stock price. So typically, when people hear that Federal Reserve is going to raise interest rates, stock price will tank, and the stock market will not be in good shape. Now let's take a look at another pretty straightforward example. The company is expected, once again, and when you see is expected, that means future dividend. Right? And that $4 is D1, and R is required rate of return 16%. Well, G is 6%, so the current price equals $4 divided by the difference between 0.16 and 0.06. That will give you $40 stock price. Now let's take a look at another example to see how we can calculate future stock price. I mean, so far we calculate the P0. Those are stock price at the current moment. Let's take a look at how we can do future stock price. Let's say, based on the previous example, let's say, how can we calculate or estimate the stock price in year 4? Stock price in year 4. So 4 years later, D1, D2, D3 are gone. Right? And also D4 has been paid. So in year 4, what investor can expect is D5, D6, all the way to DN. And at that moment, let's apply the golden growth model. And the D5 in this case is pretty much like a D1 in the case where we calculated P0. But since we are calculating P4, then this D5 is pretty much like a D1. Right? And here we apply $4 D0 times 1 plus 6% raised power 4, then we will get D5. Then we divide that number with the difference between required rate of return and the growth rate to get a stock price estimation, which is $50.50. in year 4, that is future stock price. I mean, golden growth model reveals a very strong relation between stock price and 3 factors: dividend, the growth rate, as well as the required rate of return. And in the previous case, we can do a little bit tricky work to see what we can get from estimating returns of the stock, right? And the current price for that stock was $40, and the stock price estimation in 4 years is $50.50. If that is the case, we can estimate the return of holding that stock for the next 4 years. Right? And based on calculation, you see, no matter you do manual calculation or using your calculator, return is going to be 6%. And this indicates that the stock price will grow at 6% for the next 4 years. Well, we also notice that this company has 6% of growth rate in its dividends. So essentially speaking, the stock price growth rate is essentially the same as dividend growth rate in this example. Now, let's take a look at another important issue, which is total return that we can get from a stock. Right? And total return from a stock has 2 parts. First one is the return that you can get from receiving dividends, and the second one is the capital gain. Right? And in this case, we can do a little. Let me see. We can do a little mathematical manipulation based on golden growth model. Okay, here's the mathematical manipulation based on golden growth model. I mean, stock price equals D1 divided by R minus G. And here, let's do a little algebra. Let's say we know P0, and right now we need to figure out what that R is, or required rate of return of the stock, and that is also known as expected return for the stock if the stock market is in equilibrium, or if stock prices are fairly priced. So this R, expected rate of return, can be solved based on dividend discount model, and it equals D0 times 1 plus G divided by P0 plus G. So what? You would say, so what? Well, what we are doing here is trying to decompose future stock return into 2 different parts. First one is D1 divided by P0. The second part is growth. So what does D1 divided by P0 mean? Well, this is so-called dividend yield. Right? Essentially, you look at the percentage you gain based on your dividend revenue for the next time period. Let's say stock price $10. Suppose you are going to receive $1 dividend, then your dividend yield is going to be 10%. And the second part of your return is G, right? And this G is a critical factor, determines your future capital gains. Right? So we know that there are 2 parts in your two components in your future return. One is dividend revenue, the other one is capital gain. And here we see this G is the driven factor for your future capital gain. And within your return, you have, of course, you have so-called dividend yield. Right. Now let's go back to your initial to our golden growth model. And the golden growth model is great, but there's certain conditions that you need to look at when you apply this model. This model cannot fit all situations on the financial market. It only fits small number of stocks on the market because it requires, first of all, dividend to grow at constant rate forever, right? And expect dividend yield is constant, which means company will not change the dividend yield forever. Well, Is that a reasonable assumption? To say, well, it could, but it's not that realistic. And also capital gain yield is constant and it should equal to G. And expected total return R must be greater than G. Otherwise, you will get a negative stock price. Right. So let's say, hey, let's say, well, we have a company that is expect to increase dividend by 20% in 1 year and 15% in 2 years. Well, in this case, the required rate return is 20% and the last dividend is $1. But after 2 years of high growth, the dividend growth rate will decline to 5%. And how can we fix stock price for this company? Well, this is a much more complicated case because there's no constant growth in dividend. Right? The company experienced high growth for its business, for its profits and the dividends for several years, but eventually will decline to much lower and stable number. That makes sense for many companies and that you can find on the stock market, right? So in this case, how can we fix the problem? Well, in this case, we need to use multiple stage model, 2-stage model, 3-stage model, or so on and so forth. And the key here is to find the present values of future dividends. Right? In this case, the company experienced high growth rate for first year, second year. So what we can do here is take the present values of those two highly growing dividends first. And the first dividend, $1.20. Well, the discount rate is discount rate 20%. So the present value for first dividend is going to be 1.2 divided by 1.2. And for second dividend, we continue to discount. Discount at 20% rate of return, and we discount for twice. And also we have D3, which follows constant growth, and this growth will continue into D4, D5, all the way to DN. And in this case, we wanted to simplify this problem into a scenario where we hold the stock for 2 years and sell it for during the third year, and we need to estimate the stock price in 30 years, so we can estimate the current stock price. So the first step here is to estimate the stock price during the second year if we are going to sell the stock at the end of that time period. And this P2 equals D3 divided by R minus G, and here we are applying constant growth model for the time periods beyond year 2, because beyond year 2 the company is going to have a constant growth rate. If that is the case, then we can apply golden growth model to get the stock price during at the end of the second year or beginning of the third year. And here D3 pretty much like D1 in the golden growth model, and R is 20%, G is 5%. So here we got an estimation for stock price at the end of the second year, which is $9.66. So here's the problem has been simplified, right? So we can view this stock valuation problem as the scenario where we hold the stock to receive dividend for first year, second year, and also we sell this stock at the end of the second year at $9.66. Right? So the cash flow for first year is $1.20, which is D1, and cash flow for second year is D2, which is $1.38 plus the price at which we are going to sell at the end of the second year, $9.66, and we're gonna discount the cash flow for the second year for twice by using 20% as discount rate. That will give you $8.67 of stock price. Right? This is a very typical case for non-constant growth model. Right? And we split the problem into two parts. The first one is the present values of those highly growing dividends, and the second part is found the value of the stock based on that constant growing time period in the future. And the value for future constant growth in this case equal to $9.66, right? But notice that we need to discount this $9.66 because that $9.66 is future value, not the current value. All right, so here you see a non-constant plus constant growth scenario solution. Stock price equals discounted dividends when company experience high growth rate D1 and D2, and then we solve for the time period beyond second year, right, by calculating. So P2, which is the stock price, can be realized at the end of second year, and divide that and discount this number twice to get a present value. And this P2 can be calculated based on golden growth model. This is called a two-stage model, non-constant plus constant growth model. And this picture showed you the process of solving this problem based on two-stage model. In the first stage here is year 1 and year 2, and we discount those two cash flows, right? And for the third year and the time periods beyond third year, we apply golden growth model. This $1.45 dividends pretty much like a D1 in the golden growth model, and we apply this to get future value stock at the end of the second year, which is $9.66. And also we need to discount this value back to today to get a present value, $6.70. Right? So when we add up a present value of all three cash flows, we get current stock price estimation. Right? Before we take a break, let's take a quick. Let's look at look at a quick quiz. Right? The first one is, I think both questions ask you to apply golden growth model to calculate the stock price. First one, what is the value of stock that is expected to pay a constant dividend of $2 per year if required rate of return is $15? It is 15%. In this case, we notice that dividend follows zero growth because it's constant dividend, and this is a typical case for preferred stock, and we can view this as perpetuity. So stock price estimation at time zero equals cash flow $2 divided by 15% of required rate of return. Right? I suggest you to put a 0.15 here, not 15% in your calculation. And that will give you $13.33 of stock price. Let's move to the second one. What if company starts increasing dividends by 3% per year, beginning with the next dividend? Then and also require rate of return 15%. In this case, we apply golden growth model, and if we assume that dividends are going to increase at a constant rate in the future, then we should apply golden growth model. And D1 equals $2 times 1.3. That is D1. That is D1. Divided by the difference between required rate of return and the growth rate. That will give you $17.17 stock price estimation. Right? Now let's take a break, and we will introduce more information associated with stock valuation, the features of common stock and preferred stock, as well as stock market trading mechanism.